It wasn't in a Wall Street office, a central bank, or some secret trading floor. It happened somewhere ordinary, fluorescent lit, with the faint smell of hot dogs and roasted chicken in the air. It happened at Costco. Yes, that Costco, known for bulk toilet paper, oversized jars of peanut butter, and weekend shoppers debating if they really need a 72-pack of eggs. But something unusual just unfolded here, something that should grab the attention of anyone following the silver market. In just 72 hours, Costco's entire silver stock vanished. Every last ounce, around 2.4 million ounces of physical silver, was gone. Not on sale, not part of a clearance, not promoted in any special way, just gone. To put it into perspective, this wasn't casual buying, like tossing frozen pizzas into a cart. This was a surge, a full-scale rush. Pages were being refreshed constantly, like fans vying for concert tickets. Inventory popped up, then disappeared almost immediately, sometimes faster than the system could register. Here's the most important part. These weren't tea traders or precious metal collectors coordinating buys online. These were regular Costco members, the average slice of American society: teachers, nurses, small business owners, retirees, people who likely couldn't have named the spot price of silver a month ago. And yet, all of them suddenly decided they wanted physical silver, immediately, at whatever price Costco listed. This isn't just curiosity, this is a signal. Costco had already tested the waters with gold, 1-ounce bars from Swiss refiners. They sold well, occasionally sold out, but people shrugged. It felt like a novelty. Gold is a gift, a hedge, a conversation starter. Then silver arrived, not decorative or commemorative coins, real bullion, American silver eagles in tubes of 20, 100-ounce bars from recognized refiners, same products you'd expect from specialized dealers, now available through a warehouse club, often at lower premiums and free shipping. At first, sales were steady, as expected. Mild interest from those already familiar with precious metals. Nothing extraordinary. Then, over 3 days, everything changed. Inventory evaporated. People reported refreshing product pages, watching items appear and vanish instantly. Costco employees posted online, noting back-end systems struggling to track orders coming in faster than stock could be updated manually. Hundreds of orders per minute, every SKU gone. When the dust settled, the numbers were staggering. Roughly 2.4 million ounces of silver moved through one retail channel in 72 hours. Pause to visualize that. About 75 metric tons. Equivalent to 60 sedans made entirely of silver loaded onto flatbeds. Now zoom out. Global silver mine production runs about 850 million ounces per year. Costco members consumed a meaningful chunk of that in just a weekend. The U.S. Mint produces around 15 to 20 million ounces of American silver eagles annually. Costco's 3-day sales equated to about a month of that output. Even in comparison to institutional holdings, the scale is striking. The world's largest silver ETF holds roughly 500 million ounces. Costco buyers moved a noticeable fraction of that without leverage, derivatives, or paper contracts. Just people clicking Add to Cart. And that is the crucial difference. This wasn't a single fund rebalancing its portfolio. It was thousands of independent decisions, made by people not typically chasing speculative assets. Costco shoppers are known for their methodical, value-driven habits. They avoid surprises. They buy in bulk to minimize future effort. When that demographic suddenly shifts into precious metals, it's not a chart-driven decision. Something feels off. And that tells us 3 important things. First, precious metals are no longer fringe assets. For decades, gold and silver ownership lived on the margins, hedges for the deeply cautious or skeptics of the system. Ordinary people trusted retirement accounts and assumed the system would hold. That assumption is cracking. Inflation feels permanent, deficits feel endless, and currency value is a dinner table topic. Second, the episode exposes just how thin the physical silver market is. Costco is a massive operation with enormous buying power and logistical expertise. Yet even they ran out. Restocking isn't instant. Lead times from refiners and mints are stretching from days to weeks. Capacity is finite. Refineries can only pour so much metal. Mints can only strike so many coins. Supply cannot scale overnight. Third, and most critical, it highlights the growing gap between paper silver and physical silver. While millions of ounces were bought by retail participants, the quoted spot price barely moved. Futures markets were calm. Charts appeared uneventful. Observers of paper markets alone would have seen nothing remarkable. But the physical market told a different story. The paper price assumes availability at that level. In reality, sourcing millions of ounces at spot would be impossible. Premiums surge, delivery times expand, and inventory vanishes. The number on a screen is orderly, but reality is far less forgiving. Paper markets can remain resilient until physical demand forces a reckoning. History is full of examples where logic lagged confidence, only to collapse suddenly. What happened at Costco doesn't mean silver will spike tomorrow, but it does indicate a subtle, important shift. The audience, the buyers, and their motivation have changed. The critical point is this. When shoppers who normally buy paper towels and bulk snacks suddenly start buying bullion, it's not random. It's a response to real economic stress. Costco members are rational. They optimize for value, for reliability. When they collectively decide that holding physical silver is a better hedge than leaving cash in a bank or digital dollars in accounts, it signals something far larger. This behavior tells us that tangible assets are moving from the margins to the mainstream. For decades, owning gold or silver was niche, often dismissed by professional finance as outdated or unnecessary. Now, ordinary consumers are hedging against what they perceive as systemic fragility. Inflation, deficits, rising prices, these are no longer abstract numbers on a screen. They are felt in real time: grocery bills, fuel prices, rent, mortgage renewals. And that perception drives action. People are converting currency into something finite, tangible, and outside the influence of policymakers. This is the very definition of defensive positioning. Costco's episode also illustrates just how fragile the supply chain for physical silver can be. Even a company with enormous resources and supplier relationships couldn't keep inventory in stock. Lead times are stretching. Silver supply is limited. Refineries cannot instantly pour more bars, and mints cannot strike coins at scale overnight. Smaller dealers feel the pressure even more acutely. If Costco struggles to maintain stock, independent sellers face longer waits, higher premiums, and constrained availability. Physical scarcity is now visible, not theoretical. And here's where the divergence between paper silver and physical silver becomes stark. While millions of ounces were being hoarded by retail buyers, the paper price barely flinched. Futures traded calmly. Charts seemed stable. Observers of only paper markets would see nothing remarkable. But the physical reality was completely different. The paper price assumes large quantities of metal are readily available. In reality, attempting to acquire millions of ounces at spot price would be futile. Premiums explode, delivery timelines stretch, availability disappears. The market displayed a quiet but powerful stress test: reality versus abstraction. This disconnect can persist for a time, but not indefinitely. Paper markets can seem orderly until physical demand forces a reckoning. Historical precedent shows that confidence can outlast logic, only to collapse suddenly when the system can no longer meet demand. Costco's sellout doesn't suggest silver will spike immediately. It indicates a subtle but fundamental change. The buyers have changed, and their motivation is practical, not speculative. Ordinary consumers are acting to preserve value in a system they perceive as fragile. That behavioral shift is far more impactful than any technical chart pattern. Retail participants in these circumstances often reflect reality more accurately than institutions. Analysts assume stability, assume historical relationships persist, and assume central banks can always intervene. Costco members assume none of that. They act based on tangible conditions: prices rising faster than wages, diminishing purchasing power, and uncertainty in traditional financial systems. Fiat systems fail, not because of spreadsheets or interest rates, but because trust erodes. When people stop seeing cash as neutral or safe, their behavior changes. Money no longer performs as expected. At that moment, physical assets gain priority. What happened at Costco wasn't investing in the conventional sense. It was a migration of capital, from digital abstraction into tangible, controlled wealth. And the location is critical. If this occurred only at niche bullion dealers, it might be dismissed. But it didn't. It happened in mainstream retail. Costco has around 60 million members in the US alone. Only a small fraction needs to participate to create meaningful demand. If just 1% of members buy a modest allocation, that's 600,000 individuals. At 100 ounces each, that equates to 60 million ounces, nearly 10% of global annual mine production. And that's before accounting for repeat purchases or a copycat effect. Once one major retailer demonstrates demand, others notice. Walmart, Amazon, independent dealers all start reacting. Physical silver shifts from novelty to necessity. At this point, demand accelerates faster than supply can respond. Global refining capacity may sound ample, but most silver production is already allocated to industrial use: electronics, solar panels, medical equipment. Investment-grade silver is a smaller fraction, typically a couple 100 million ounces annually. If mainstream retail demand doubles or triples that slice, supply simply cannot scale. The result is immediate friction. Premiums rise, delivery times extend, inventory becomes sporadic, dealers limit quantities or temporarily delist products. We are seeing the early signs of a physical silver squeeze. The next phase involves visibility. Media coverage follows scarcity. Empty listings and rapid sellouts turn curiosity into urgency. Retail participants who never considered silver begin to act. Shortages become headlines. Headlines drive further buyers, deepening scarcity. At this stage, premiums detach from the spot price. Physical silver trades according to availability, not abstract pricing models. Institutional players may see arbitrage opportunities, buy futures, take delivery, and sell physical silver at a premium. But taking delivery at scale exposes infrastructure limitations. Registered inventories are finite. Delivery mechanisms are not designed for mass conversions. If tested en masse, the system struggles. Exchanges face stark choices: honor contracts with sharp price spikes, or settle in cash, exposing scarcity. Either choice challenges confidence. Regulatory intervention may occur, not out of interest in silver, but to preserve systemic credibility. Historical precedent shows such interventions often backfire, reinforcing the desire to hold physical metal. In the end, market pricing responds to what can actually be delivered, not what is promised or charted. Once the structural shift begins, trends accelerate. Physical silver becomes increasingly scarce. Dealers adjust premiums, delivery times stretch, and availability becomes intermittent. Small shortages turn into larger ones, unnoticed until they become obvious. Costco's 72-hour sellout is a perfect example. It wasn't chaos, it was a signal. Regular people who never cared about bullion before decided in unison that holding physical silver was sensible. Millions of ounces disappeared in days, and this is just one retailer in one weekend. Multiply that behavior across multiple platforms and stores, and the math quickly breaks down. Supply cannot keep pace with demand, and prices adjust accordingly. This is not speculation. This is supply and demand in action. Those who moved early, Costco shoppers, will look prescient in hindsight, but the lesson is expensive if ignored. The key takeaway: physical silver is no longer a niche hedge. It is becoming mainstream insurance against a system under stress. So, what should you do with this information? First, recognize that this is not about timing a quick profit. This is about positioning for a structural shift. Costco's sellout suggests we are entering a phase where physical precious metals move from the margins to the center of financial consciousness. This transition is gradual, spanning years rather than weeks. A 3 to 5 year horizon is realistic. Second, if you don't own physical silver yet, consider this a wake-up call. This isn't about wealth generation, it's about insurance. That's exactly the rationale of the Costco buyers. Hedging uncertainty, protecting a portion of wealth in tangible assets outside digital ledgers and counterparty risk. A commonly cited guideline is 5 and 10% of net worth in physical precious metals. For someone with $100,000 in savings and investments, allocating $5,000, $10,000 to silver or gold is historically conservative. Third, be aware that premiums are unlikely to return to previous levels. Buying silver just a few dollars over spot may be a thing of the past. Standard products, like Silver Eagles or generic rounds, may now carry premiums of $5, $8, or even $10. Larger bars may still have lower premiums, but those too are rising. This isn't a conspiracy. It's a reflection of tight physical supply. Waiting for premiums to collapse may mean missing the opportunity entirely. Fourth, timing and delivery require realism. Larger orders come with lead times, sometimes 6 to 8 weeks. This is not a reason to delay. Locking in an order now is safer than trying to buy during a panic when inventory disappears entirely or prices spike overnight. Costco buyers didn't wait. They acted early and secured metal. Fifth, consider spreading purchases over time. Nobody can predict whether silver dips to the high 20s or jumps into the 40s short term. Dollar cost averaging smooths volatility, building your position gradually. That's how disciplined accumulation works. Sixth, storage is critical. Physical ownership demands responsibility. Do not leave metal in obvious or insecure places. A secured safe or professional storage offering, segregated, allocated storage is essential. Bank safe deposit boxes may not guarantee access during disruptions. Control matters. Seventh, practice discretion. This isn't paranoia, it's common sense. Advertising ownership of precious metals can create unnecessary risk. Inform only trusted individuals, a spouse or advisor. Operational security matters as conditions deteriorate. Eighth, prepare emotionally for volatility. Silver isn't smooth. Prices swing violently. You could buy at $35 and watch it drop to $28. That doesn't negate the rationale. Insurance fluctuates in price, but still fulfills its purpose. Costco buyers aren't day trading, they are hedging systemic risk. Ninth, stay observant. Watch for Costco restocks. If inventory disappears again, it's confirmation. Observe other retailers. Track premiums and delivery times. Rising premiums and longer waits are signals, not noise. Finally, understand the endgame. At some point, scarcity reaches critical mass. It could be due to delivery failures, policy responses, or broader economic events. When that happens, physical silver won't just be expensive, it may be impossible to source. Dealers may stop quoting prices because no metal is available. At that point, premiums are irrelevant. Ownership becomes impossible if you don't already hold it. The window of opportunity is now, not after the mainstream catches up. While Costco's sellout might seem niche or incidental, one weekend of rapid sales, it is anything but random. Regular people acted decisively, draining millions of ounces in a short period. Imagine this behavior spreading across other platforms, stores, and regions. Supply won't keep up. Prices will rise until only the most committed participants remain. This is not prophecy. It's straightforward economics. Supply, demand, and scarcity. The Costco buyers moved early and effectively. Those who wait risk paying more or being unable to acquire silver at any price. Consider the broader implications. Silver is unique because it serves as both an industrial necessity and an investment. Factories don't pause for market commentary. They pay whatever is necessary to keep production running. When a material is both essential and scarce, the ceiling for its price is far higher than many expect. Costco's importance goes beyond retail. It is a demographic indicator. Its members represent the middle class, the backbone of the economy, not the ultra-wealthy, not the desperate. When this group purchases defensive quantities of silver, it signals that economic anxiety has passed a threshold. People aren't just worried, they are preparing. And here's the paradox. Widespread preparation can accelerate the very outcome feared. Financial panics work this way. Worry about instability drives demand for physical assets. This drains supply, exposes fragility in paper markets, triggers repricing, and fuels broader instability. Fear doesn't just forecast crisis, it creates it. Costco is a canary in the coal mine in the most methodical way possible. 2.4 million ounces in 72 hours is the signal. Consumers perceive risk. So, what's actionable here? Don't chase quick trades. Instead, position for structural change. Physical precious metals are moving from fringe hedges to mainstream defensive assets. This transition is long-term, unfolding over several years. Early, disciplined accumulation is the key. If you haven't already, consider allocating 5 to 10% of your net worth to physical silver or gold. Understand that premiums are likely to remain elevated. Delivery times may stretch, so act early rather than waiting for panic to hit. Dollar cost averaging, secure storage, discretion, and emotional preparedness are all essential. Ultimately, this isn't speculation. It's a market reality test. Costco's sellout shows ordinary people acting rationally to preserve tangible value. Millions of ounces disappeared in days. The question is whether you notice the signal now or wait until it is too late. Because when scarcity hits full force, it won't be announced on the news. It will be evident in empty shelves, unavailable inventory, and rising premiums. And then, hindsight alone will teach the lesson. The story of Costco is simple yet profound. Mainstream consumers are waking up to physical precious metals, acting decisively, and reshaping demand. That's the signal no analyst chart can fully capture. And it's happening now, in real time, in a fluorescent lit warehouse, right between the paper towels and the checkout line.